let's clear up one of the most misunderstood concepts in finance: the difference between enterprise value and equity value. Whether you're preparing for consulting or investment banking interviews, this concept is everywhere. And it's where many candidates lose points, even if they know the formulas. Enterprise value is the value of the entire business to all stakeholders, both debt and equity holders. Here's the standard formula. Enterprise value equals equity value plus net debt plus minority interest plus preferred equity minus cash. But why do we subtract cash? Because enterprise value measures the value of the core operating business. If a company has excess cash, that cash doesn't contribute to operations. It's something a buyer could use to immediately pay down debt or return to shareholders. Subtracting cash adjusts for non-operating assets, ensuring we value only the business itself, not the cash sitting on the balance sheet. Let's make this real. Imagine Company X, a public firm. Market cap, $500 million. Total debt, $200 million. Cash, $50 million. Enterprise value equals $500 million plus $200 million minus $50 million, which totals $650 million. That $650 million reflects what a buyer would effectively pay for the operations, after accounting for the ability to use cash to pay down part of the debt. Equity value is simpler. It's what belongs to shareholders. For public companies, it's just share price multiplied by the number of shares. For private companies, it's usually the post-money valuation or what investors are willing to pay for the equity. Equity value represents the residual claim after all obligations. If you buy all the shares, you own the equity, but you're also taking on the debt. By the way, if you want to dive deeper into this concept and level up your interview prep for investment banking, I highly recommend our free foundation course, available at thesingsters.com. It's concise, practical, and tailored for 2025 recruiting. Now, let's get back to the video. For public companies, calculating these values is straightforward. Equity value comes from the market cap. Enterprise value uses balance sheet data to adjust for debt, cash, and other components. For private companies, there's no stock price, so equity value often comes from funding rounds or negotiated valuations. Enterprise value is then calculated by adjusting that valuation for net debt and cash. The logic is exactly the same. The difference is where the inputs come from. Here's the essence. Enterprise value equals the value of the business itself. Equity value equals the value to shareholders. Enterprise value is capital structure neutral. It tells you what the business is worth before financing. Equity value depends on capital structure, debt, cash, and other claims affected. If you're interviewing at firms like Goldman Sachs or JP Morgan, here are common questions they love to ask. Walk me through the difference between enterprise value and equity value. Why do we subtract cash in the enterprise value formula? What happens to enterprise and equity value if a company issues new debt? Which multiples would you use to compare companies with different capital structures? These aren't trick questions, but they test whether you truly understand the logic, not just the formula. If you found this helpful, make sure to subscribe to The Thinksters, where we break down complex finance and consulting concepts clearly and practically. Thank you for watching, and we look forward to helping you succeed in your finance career.